Do you use currency strength and weakness in your trading? If not, why not? Hi and welcome to today's video with me, John, on Friday the 5th of May. Here we're going to do a little bit of a roundup of what we talked about this week to our members. So we actually spoke about a few currency pairs this week. We spoke about the likes of CAD yen, Swiss yen, Euro yen, CAD Swiss. There wasn't too much going on the tables this week, which really kind of narrowed our opportunities. But that's the beauty of the tables. Instead of us trying to find opportunities and falling into a trap of trading constantly, we want to be finding those types of markets where the momentum is with the market, which gives us a better opportunity to capitalize on our trades. Now, the only real kind of option we had this week was CAD Swiss to the downside. There was a lot of yen weakness going into this week. If I scroll back to Tuesday, you can see that we had yen featuring as the weak currency, which was one of the only confluences we had of this week, apart from when we started to see CAD Swiss join the tables through here. So we checked out a few yen pairs. We checked out CAD Swiss. Now CAD Swiss performed as expected, really. We looked at the price projecting the 0 spot 66.25 handle. We entered a short position the next day, looking to target the 0 spot 65 handle, and price came nicely into that level there. So we pretty much did exactly what was said on the tin. Saw the pre-signal turn up on Tuesday, where we had the confluence with CAD being on the weak side of the tables. We then waited for another currency to appear. That currency happened to be the Swiss franc, which appeared on both tables. On the 9 AM day traders table especially is where we had the confluence and the signal that CAD Swiss was the one to trade. We took the short. We were only targeting 0 spot 65 because it was the major swing low, so we didn't really want to trade below this point anyway. And it's a good job we didn't, because price has then reversed and we've seen price rally up back towards the 0 spot 66.25, which we said could happen in that video. Another market we took a look at this week, or was definitely on our radar, was Swiss yen. Again, the Swiss franc was appearing at the top of the tables from a trend trader's perspective. The only thing we had was the yen started to remove itself. So when the yen started to do that, it gave us an early signal that we weren't meant to look for long opportunities anymore. Now, when we first talked about Swiss yen was when we had this daily bearish candle here, and we said the one thing that we could potentially look at was a pullback into the 150, 150. But if price got to the 150, 150, and Swiss yen didn't return on the tables, in fact you can actually see Swiss yen was on the same side of the day traders table, which is not what we look for, then we shouldn't be looking for longs. Now I think this is a perfect example of where retail traders could go wrong over traders using a secondary tool to help them with momentum in the market. Because if we took a look, or we'll take a look at Swiss yen here, and if we take the typical retail trader mindset of if price is in an upward trend and price comes back to the previous highs, we should be a buyer, you'll be in the hole at the moment. Because if you were looking for price to come back to 150, 150 and bought just because we're in an uptrend, then you would have gone long here. If you were trying to be safe with your stop loss, yeah, you'd probably still be in the trade, but you have a negative reward to risk ratio back to the 154 handle. If anything, you probably went long at 150, 150, or if that candle closed like that and you put your stop loss there, so you've probably been knocked out of that trade, or you would be 140 pips in the hole at the moment. The thing is, when price got back to here, okay, so that was yesterday, Thursday, and it was telling us that Swiss yen was not one to watch anymore. Okay, so price has then traded through that level. So we're not involved with that, which is great. Tables have helped us stay away from the market. Another interesting pair we looked at this week was Euro yen. Now, Euro yen was quite an interesting market just because price blasted through some key highs. Okay, so if we look at 151, 148 was the level, 148.50 were these 2014 highs. And again, we were watching this because the yen was showing us that it was a weak currency. It blasted through the level. If we take a look at it, we were on the daily time frame at the time. We again look at it as from the retail trader point of view. If it was in an upward trend, we said, yeah, if price comes back to 148.50, you could potentially look to buy it. But it doesn't feature on the tables, okay? It's not on the tables for a long anymore. In fact, look where euro is here. It's now on the weak side of the table and yen is on the strong. So it's actually the opposite. It's saying that price could potentially come lower. There's no confluence with the tables. And again, if you've just gone long from 148.50 blindly without using this information here, then you would be negatively offside at the moment, or again, you'd be in another losing trade. So it's important to use the tables in confluence with those technicals as well. But it's important that we get all our information from these tables because they show us where that momentum is lying. At the moment, it's telling us it's with New Zealand dollar and Aussie US dollar. It is a Friday though, and we do have NFP today, so it's probably not the best day to look for trades and opportunities. But that's an example of now you could be looking at those type of forex pairs for opportunities if there is room to do so. So I'm gonna leave it there. I hope you enjoyed all the content this week. I hope you learned a lot from it, and I'll speak to you in the next video.